So last week we stopped here. We talked about short-term financing with bank loans, and we talked about three kinds of bank loans: the single end-of-period payment loan, and line of credit, and this bridge loan. So today we talk about interest calculation. More specifically, we will talk about how could we calculate the effective interest rate on a loan if there are all kinds of fees. To be more specifically, we will talk about loan commitment fees, loan origination fees, and compensating balances requirement. So first, commitment fees. These are fees which are charged on unused credit line to compensate the bank for its service. So let's say there's a firm. This firm has negotiated a committed line of credit of $1 million, and the interest rate is 10%, and the commitment fee is 0.5%. So let's say the firm decides to borrow $800,000 at the beginning of the year, and then $200,000 are not used, and then the firm decides to repay the loan at the end of the year. So the total cost of the loan is basically there are two parts here. First, it's the interest charges, and we know that the interest rate is 10%, and the firm borrows $800,000. So the interest charge would be $800,000 times 10%, which gives us $80,000. And then, additional to this interest charge, the firm will have to pay commitment fee. And we know that the commitment fee is a percentage, it's 0.5%. So the second part of the charge would be the unused amount times the commitment fee. So it's $200,000 times 0.5%, which gives us 1,000. And you can see that obviously because of this commitment fee, the firm's fees plus interest rate will be larger compared with the interest expense. This essentially says the effective interest rate is actually higher. If you do the calculation in this case quite simply, you can see that the total payment is this, and the firm only borrowed $800,000. So clearly this is larger than 10%, right? So basically the commitment fee increases the effective rate of debt. Okay. The second type of fee we're going to talk about is the loan origination fee. So this is a fee the firm has to pay when it initiates the loan from the bank. Since it's a fee, you can see that when the firm gets money from the bank, it has to pay the fee. So the fee will effectively reduce the amount of cash the firm can get from the bank. And this will again increase the effective interest rate of the loan. Let's see this example here. So we assume the firm Timmons is offered a $500,000 loan for 3 months. And we assume the APR is 12%. And we assume there is, I think it's quarterly compounding. So we assume there is quarterly compounding. And let's assume the loan has a loan origination fee of 1%. This is charged on the $500,000 principal. So you can see that as long as the firm borrows $500,000. At the same time, it needs to pay out this amount, right? So this is the loan origination fee. And clearly you can see that this origination fee will reduce the amount the firm can get. And this will increase the firm's effective interest rate, because if you do the calculation, you can show that first, we know that the interest rate is 12% APR. And if we have quarterly compounding, then it means that the 3-month interest rate is 12% divided by 4, which is 3%, right? So if the firm borrows for 3 months, then it has to pay $500,000 times 3%, which is $15,000. And in this case, we can calculate the effective interest rate. You can see that the firm pays $15,000 of interest expense, and the firm gets this amount of money from the bank. And this will give us a interest rate of 4.04%, right? And you can see that this is higher than 3% interest rate. The reason, again, is because of the loan origination fee, which reduces this notional amount to this actual smaller amount, right? Okay. Of course, if you have the 3-month interest rate, you can also find out the effective annual rate, right? Because we have basically 3-month interest rate, and we have 4 quarters per year, right? So we have a exponential of 4 here minus 1. This gives us the effective annual rate. Okay, the third type of cost is compensating balance requirement. Here, compensating balance requirement means the firm must hold a certain percentage of the principal of the loan in the account at the bank. You can see that because of the compensating balance requirement, the proceeds from the loan will be reduced. Okay, let's see the example. Timmins Bank requires that 10% of loan principal in a non-interest bearing account as compensating balance. So basically here, 10% would serve as compensating balance, and the firm will not pay interest on the compensating balance. Sorry, the bank will not pay interest on the compensating balance. And given a $500,000 loan, Timmins must hold $58,000 as compensating balance, just 10%, right? So basically it means that even the firm has a $500,000 loan, the firm will only get $450,000, right? So this is the amount the firm will get. And now let's see what is the amount the firm has to pay at the end of the 3rd month. So the interest payment will be based on the $500,000, which means the firm will need to pay this amount of interest payment. And then the firm will need to pay back the principal of $500,000, but the firm has compensating balance. So the actual amount, the actual principal the firm needs to pay is only $500,000 minus the compensating balance. So essentially you can see that compensating balance will reduce the loan proceeds the firm can get, and it will also reduce the firm's final payment. That's why you get this $500,000 minus $50,000 here. And then the interest rate will be 3.33%. And you can see that again, this is larger than the APR of 3%, right? Because we have a 12% APR with quarterly compounding. So the per quarter interest rate is 3%. And due to the compensating balance, the effective interest rate is larger than 3%. Okay, let's see this very simple question here. So assume Timmins Bank pays actually 1% on its compensating balance account. So we assume here this 1% is an APR with quarterly compounding, which means per quarter interest rate should be 0.25%. And you can see that the difference compared with the example in the previous page is now the bank will pay interest rate on the compensating balance. What is the effective annual rate of Timmins 3-month loan? The calculation would roughly be the same. Remember that we have a loan amount of $500,000. And the firm needs to put 10% of this amount as compensating balance. So the actual proceeds the firm can get from the loan is $450,000. And again, the firm needs to pay the interest rate based on this $500,000 times 3%. And after 3 months, the firm needs to pay back the principal. And here the firm has the compensating balance sitting in its account. And the bank will pay 1% APR on the compensating balance, which means the compensating balance of $50,000 will become $50,000 times 1 plus the APR 3-month rate, right? So it's 1 plus 0.25%. And this will give us a number of, let me see. Do we have the answer here? Oh no. Yeah, we will have a rate of 3.31%. And you can see that this effective interest rate is slightly lower compared with this 3.33%, right? The reason is because the bank is paying interest on the firm's compensating balance. Okay, let's move on to the next section, which is about commercial paper. We will talk about short-term financing with commercial paper. And commercial paper is really an important way for large firms to do this short-term financing. Commercial paper is short-term unsecured debt issued by large firms. So generally only large firms can use commercial paper for short-term financing. This is generally cheaper compared with the bank loan. And generally commercial paper has a large face value, at least let's say $100,000. And it's short term, so its maturity is 30 days and at most 12 months. And commercial paper is also rated by credit rating agencies, just like corporate bond. There are two kinds of commercial papers. the first one is called direct paper. Judging from the name, it basically means the firm directly sells commercial paper to investors. And then there's dealer paper. In this case, it basically means that the dealer will sell the commercial papers to investors. So basically what happens is the firm will sell commercial papers to dealers, and then dealers will sell these commercial papers to investors. And generally, investment banks and large commercial banks will serve as dealers. Of course, firms which sells commercial papers will have to pay some service fees to these commercial paper dealers. And then if you compare direct paper and dealer paper, then dealer paper is more widely used. Okay, again, let's calculate the effective annual rate of commercial paper. So this chapter is actually quite simple. You're basically doing two things. First, you're learning some basic concepts, right? And then you'll do some very simple calculation. And most of these calculations is just about calculating effective annual rate. So let's say a firm issues 3-month commercial paper with $100,000 of face value, and it receives $98,000. Then the question is, what is the EAR for this debt? This is like the simplest problem in this chapter. So what you will do is, first we know that this is a 3-month commercial paper. So the 3-month interest rate would be calculated as this face value divided by the actual money the firm can get. And then we are looking for effective annual rate. So we have to annualize this 3-month rate. And we know that we have 12 months per year, and then we only have a 3-month interest rate here. So we need a exponential of 4, then minus 1. This gives us the effective annual rate. So it's 2.04%. Okay, now let's talk about short-term financing with secured financing. So here we will mainly talk about firms will secure loans with collaterals. Here we specifically talk about firms' accounts receivables or inventory as collaterals. So we first talk about the firm uses accounts receivable as collateral. Well, you can see that accounts receivable sits on the firm's balance sheet, and it's the firm's current asset. So it's actually sensible for a firm to use accounts receivable as collateral to obtain short-term financing, right? There are several kinds. The first kind is called pledging of accounts receivable agreement. So in this type of agreement, the bank, the lender, will look at the firm's invoices. And then the bank will determine the creditworthiness of these invoices. And the bank can then decide which invoice can serve as collateral for this loan. And then the lender will lend the money to the firm. And generally, the lender will only lend the firm some percentage of the value of the accepted invoices. And if the borrowing firm's customers default on their bills, the firm will be still responsible to the lender for the money. Right? So graphically, it basically means that the bank will look at the firm's accounts receivable. And let's say we have several invoices from the firm's customers. And then the bank will examine these invoices. And maybe the firm has its some determination process on which invoice is suitable as a collateral. Let's say in the end let's say in the end the bank decides, okay, these two invoices can serve as collateral. And then the firm can see that this invoice has an amount of, let's say, $1 million. And the second invoice has an amount of $0.5 million. And then the bank says, okay, there is a total of $1.5 million of collateral, and I will give you, let's say, 80%. So in this case, the firm can get a loan, a short-term loan of $1.2 million, right? And then we could also use factoring. So a factoring of accounts receivable agreement. In this case, a firm will just sell its accounts receivables to the lender, which is also called the factor. And then the lender or the factor will pay the firm the amount due from its customers at the end of the firm's payment period. And in exchange for this kind of service, the firm will need to pay a 1% or 2% factor's fee. And the beauty of this type of this agreement is the firm can actually borrow up to 80% of the face value of its accounts receivables. And in this case, if the firm decides to borrow, then the firm needs to pay two fees, both the factor's fees and the interest rate on the borrowed amount. So graphically, this basically means that the firm, let's say there's a firm, right? Oh, sorry. Ah, boy. So let's say there's a firm. And then there's a lender or factor. So what will happen is the firm will sell its accounts receivable to the lender. And lender will give some money to the firm, right? At the same time, the firm needs to pay factor's fee. And if the firm borrows, there will also be interest payment. And then the firm definitely has some customers, right? Normally, the customers should pay the firm, right? However, if the firm sells its accounts receivables to the lender, then what happens is the customer will actually pay. Then what happens is the customers will actually pay the lender. Okay, now let's talk about inventory. Clearly, inventory is one type of current asset. It can also be used as a collateral in short-term financing. Inventory can be used in three ways. The first is a floating lien. The second is a trust receipt. The third, warehouse agreement. So in a floating lien, all of the firm's inventory is used as collateral to secure a loan. This is risky because in a floating lien, the firm can still sell its inventory. So you can see that if the value of the inventory decreases because the firm sells inventory, then it's possible the loan is under collateralized. That's why generally lenders will only loan a low percentage of the value of the inventory and charge a higher interest rate just to compensate this type of risk. Then the second is the trust receipt loan. In this case, inventories will be held in a trust as security for the loan. And then as the firm sells the inventory, the firm will use the proceeds from the sale to pay back the lender. And in a warehouse agreement, the inventory will sit in a warehouse and serve as a collateral. It's the least risky one, but it's expensive because there is warehouse fees and other storage costs. And it's also inconvenient because the lender want to make sure that the inventory still sits in the warehouse. So potentially the lender might want to ask a third party to monitor the inflow and outflow of inventories. And then based on the contract, possibly the borrowing firm will need the lender's permission to sell inventories. Okay, let's see this problems here. So the Roe Cannery wants to borrow $2 million for 1 month. Using its inventory as collateral, it can obtain a 12% APR loan. We assume monthly compounding. The lender requires the warehouse arrangement to be used. The warehouse fee is $10,000 and it will be paid at the end of the month. Calculate the effective annual rate of this loan for Roe Cannery. So we'll first calculate the 1 month interest rate. Is the firm gets $2 million and it will borrow for 1 month. So at the end of the month, it will need to pay 2 times 1 plus interest rate, because we know we have 12% APR and we have monthly compounding. So per month interest rate would be 1%. And then the firm also needs to pay the warehouse fee, which is $10,000, right? So this should give us a, let's see, what do we get here? This gives us an interest rate of 1.5%. And then we want to annualize this. So we have 1 plus 1.5% and an exponential of 12. So this gives us an annual rate of 19.6%. So if you compare the effective annual rate with APR, you can see that it's much higher, right? The reason is because you have to pay this $10,000 very high warehouse fee. Okay, so this chapter is pretty simple, right? As I said, just some basic concepts and some very simple calculations. So let's look at the chapter review questions. So what is the effect of seasonalities on short-term cash flows? In a nutshell, basically, if there are seasonalities, then your cash flows will have seasonalities. That is, you will have low cash flows in a low season and you will have high cash flows in a peak season. So potentially this means if you have negative cash flow in a low season, then you will want to obtain short-term financing. So what is the difference between temporary and permanent working capital? First, what is permanent working capital? It basically means that you have to maintain the minimum amount of working capital if you want to continue your firm's operation, right? So this minimum amount is called permanent working capital because you have to permanently maintain that level. And then temporary working capital really depends on your the maybe seasonality or fluctuations or cycles of your business operations, right? And the concept or the definition of temporary working capital is temporary working capital is the difference between your working capital and permanent working capital, or you could say your working capital equals permanent working capital plus temporary working capital. What is the difference between a committed and uncommitted line of credit? Well, this is simple, right? You can guess this from the name. If it's committed, then it means the bank is legally binding to provide the credit if the firm does not violate the contract with the bank. Then uncommitted, it means that the bank is uncommitted. That is, it is not legally binding to provide credit to the firm. What is a commercial paper? So commercial paper is short-term unsecured debt issued by large firms. What is the difference between a floating lien and a trust receipt? A floating lien basically means you will use all your inventory as collateral. However, you have the freedom to sell your inventory. And a trust receipt means you will use your inventory as collateral, but you will put that inventory in a trust. And as you sell your inventory, you should use your proceeds to pay back your loan. Okay, we have finished this simple chapter, so let's move on to the next one, which is chapter 28, merger and acquisition. Okay, chapter 28, merger and acquisition. Merger and acquisition is pretty interesting, both from the perspective of corporate finance and the perspective of investment. So let's first talk about some basic facts or basic concepts of merger and acquisition. Whenever there is a merger and acquisition, there is a change of corporate control. That is, who controls the firm will change. And if it's a acquisition, which is also called takeover, then it means there is a acquirer or a bidder. It acquires a seller, and we call the seller the target firm. If it's a merger, then the target firm merges with another firm. Generally, merger is friendly. Friendly means that the board of directors of both firms, they agree to merge with each other. Acquisition can be hostile. If it's hostile, it generally means that the target firm don't want to get acquired by the acquiring firm. But then the acquiring firm will still try to take over this target firm. And merger and acquisition is a very important market. And on average, we have $1 trillion per year in transaction value. So here you can see a list of large merger and acquisition. And you can see that generally these mergers are quite big. If you look at these three, these are essentially the largest ones. And so the three largest ones, they occurred around the dot-com bubble. And they're at the scale of hundreds of billions of dollars. The M&A market is featured by merger waves. That is, you can see waves of merger and acquisition activities. Generally, you will see very large volume during the peak, and then you will see very few transactions in the trough. The largest merger waves occurred in the 1960s, 1980s, 1990s, and 2000s. So if you look at this picture, you can see that we have some pigs, right? So this is 1960s. This is 1980s. This is 70s, right? This is around the dot-com bubble. And you can see that these waves are pretty volatile, right? You can see that in the peak, it's quite high. And then it quickly fell to the trough. And the trough is actually quite deep. And merger and acquisition is a very active research area. One research is about what causes or what drives merger waves. So you can see that this is a table from Hartford, a paper written in 2005. And you can see that merger waves are basically driven by several forces. It could be economic, it could be due to regulations, or it could be due to technology. So for example, if you look at this, right? So there was a merger wave in aircraft industry around 2000, and you can see that this is because of it's more related to technology, because big older airplanes require increased maintenance, repair, and overhaul, and the airliners, they outsourced this, and then this created this merger wave. Okay, there are several types of mergers. The first one is horizontal merger. Just from the name, right, you can see that it basically means the target and the acquisition firm, they're in the same industry. That's why it is horizontal. So essentially we're looking at the supply chain. If the target and the acquirer, they're at the same location of the supply chain, then it's horizontal. For example, HP merged with Compaq. I forget the year, but both of these firms, at least I know that they produced laptops. And Exxon merged with Mobil, right? That created Exxon Mobil. And then there's vertical merger, that is the merger of two firms along the supply chain, such as eBay merged with PayPal. So you can see that this is a vertical merger, because if you look at the supply chain here, then PayPal is the upstream firm, right? It's upstream. And then eBay is downstream, right? Because eBay is essentially consumer facing and PayPal is about payment processing. And then the third type of merger is conglomerate merger. It basically means the target and the acquirer, they're in different industries. For example, Disney merged with ABC, the American Broadcasting Company. And you can see that Disney is essentially so what's the industry? Resort operator or theme park operator, right? And then ABC is a media firm, right? So you can see that they are different when they merged. And next we talk about the payment of merger and acquisition. M&A deals can be different, depends on how target shareholders are compensated. Because you can see that if a acquirer, right, acquires target, then you have to think how target firms' shareholders are paid, right? So how do we pay the target firm's shareholders? Well, the acquisition firm can pay target firm shareholders either using cash or using stocks. So generally, the stocks will be the acquirer's stocks or the merged firm's stocks. So this is also called stock swap. Basically, it means that the target shareholders, they will receive the acquirer's stock as payment for target shares. Okay. Now let's examine the market reaction to M&A. So it's a very interesting topic, and it actually generates a lot of buzz in financial media. So let's see some basic facts. First, most acquirers, they pay a large acquisition premium to acquire the target. So how do you calculate the acquisition premium? Well, acquisition premium is the percentage difference between the acquisition price and the firm's price before merger announcement. For example, if the target firm's stock price was $100, and then the acquiring firm decides to acquire the target firm at a per share price of 150. Then in this case, you can see that the acquisition premium is 50%. And based on the data, acquirers generally pay an average of 43% premium. And you can see that this is a very large premium, right? Because it's 43% higher. Okay, let's see the price reaction to merger and acquisition. So if a merger and acquisition is announced, then the target firm's price on average will enjoy a gain of 15%. And the acquiring firm will see on average a gain of 1%. And in half of these transactions, the acquirer's price will actually decrease. So this is actually interesting, right? There are several interesting points to make. The first is you can see that the acquirer pays an average premium of 43%. You want to ask why? Why the acquiring firms wanted to pay such a huge premium? Second, if you compare the premium of 43% with this 15% gain, you can see that the gain is actually smaller compared with this 43%, right? So why do we see this? It's like a target firm has a price of $100, and then the acquiring firm decides to buy it for $143. And after learning about the news, the target firm's share price will only increase to $115, right? Why? And then the third question is, why the price reaction of the acquiring firm is so small? It's almost just 1%. And even in some cases, the acquiring firm's price will actually decrease, right? Okay, now let's first answer the first question. That is, why do acquiring firms want to pay a premium over the market value for a target firm? Why there is this 43% acquisition premium? Okay, so the main argument is there are various benefits in merger and acquisition, and potentially these benefits will justify why there is acquisition premium. So we will talk about the following benefits. The first is called large synergies. This is the most common justification for acquiring firms to argue why they want to pay the acquisition premium. So basically, synergy means that if two firms they merge together, then their operations can be complementary, right? So that's why it is called synergy. For example, this firm SBC, Southwestern Bell Corporation, acquired AT&T in 2005 for more than $15 billion. And then its chairman wants to argue why he would want to pay $15 billion. Then his argument was, well, we have forecasted the synergies. And we found out the synergies were about $15 billion. So the synergies alone can justify the price SBC agreed to pay for AT&T. Now, there are many two types of synergies. The first is cost reduction synergies. Just by the name, you can guess that it's about reducing cost. So most likely there will be layoffs. This is easy to achieve because what you need to do is after the merger has finished, you just lay off overlapping employees and you will remove redundant resources. For example, the SBC and AT&T acquisition forecasted 13,000 layoffs in the first year after the merger finished. And the second type of synergy is the revenue enhancement synergies. For example, in 2008, Delta and Northwest, they merged. Both of them are airliners, and they forecasted $200 to $300 million per year in the revenue enhancement synergies because they think after merging with each other, they would expand their network, they would have more flight options. So this would bring more customers, and this will increase their revenue and increase their customers' loyalty. But you can see that this type of synergies could be harder to predict and achieve. The second reason that merger and acquisition can be beneficial is due to the economies of scale and the economies of scope. So both of these concepts are from introductory economics courses. Economies of scale basically means as you produce more or as you increase the quantity of your production, then the cost will be lower, right? So, for example, in 2008, Payless Shoes acquired another shoe firm, Stride Right, and then this firm also acquired a different shoe firm. I don't know these firms. So I guess it's called Saucony or Saucony in 2005. So you can see that here we're looking at economies of scale because we basically merge three different shoe companies into one, and then their joint production quantity will be larger. So this could save some cost. If you dig this a little deeper, you can see that this is because of fixed cost, right? Because if you're building a firm, then you have to pay a certain fixed cost. Let's say you have a fixed cost of $1,000. And if you produce 100 products, then the per product fixed cost would be $10. But if you produce 1,000 products, then in this case, per product fixed cost is only $1, right? So basically it's 1,000 divided by 100 versus 1,000 divided by 1,000. Okay, the economies of scope. So it means there will be savings if the firm produces goods in large varieties. For example, Kraft in 2009 acquired a chocolate maker, Cadbury. And you can see that Kraft is a food processing firm with a lot of different brands. So in this case, you can see that by acquiring Cadbury, the chocolate maker, it essentially expands its varieties. And merger and acquisition can be beneficial if it is a vertical merger. In a vertical merger, there is a benefit of coordination. So basically, if we put two firms under central control, then management can ensure that both firms will work towards a common goal. For example, in a vertical merger, AT&T buys Time Warner, and you can see that this is a vertical merger because AT&T is the media distribution firm, and Time Warner is a content creator, right? So basically, Time Warner will be at upstream, and AT&T will be at the supply chains downstream. Right? Okay. Okay, another benefit is about expertise. This is quite easy to understand. It basically means that the acquiring firm needs some expertise in certain area. Then instead of developing these expertises in-house, the acquiring firm decides to go outside to find a target firm, directly acquire the expertise it needs, right? You can see a lot of example about this, especially in technology sectors. The reason is because for some new technologies, developing it in-house by hiring experienced workers can be difficult, and potentially it will be more efficient if the acquiring firm directly purchased the talent through merger and acquisition. For example, Facebook acquired Oculus Rift, and you can see that Facebook is a social networking firm, and let's say it wants to develop some expertise in virtual reality. So it decides to directly acquire Oculus Rift, which is the top firm in virtual reality. And then there are also this monopoly gains. The economic argument here is if two firms they merge together, especially if this is a horizontal merger. That is, these two firms they belong to the same industry. Then in this case, if these two firms they merge, then they will reduce the competition, right? I mean, it's like obvious. If WestJet merges with Air Canada, then you can see that no one will compete with Air Canada. And you can imagine that if the competition in the market is smaller, then generally the firm will enjoy a higher profit. This is also from introductory economic courses. And we know that a firm can earn the highest possible profit if it's a monopoly. So if using merger, the firm can reduce competition and move closer to monopoly, then the firm will enjoy a higher profit. But you can see that this is generally undesirable. We know that in the market, competitive market is more efficient compared with a monopoly. So if merger and acquisition reduces competition, generally the whole economy or the whole society will bear the cost of monopoly. So that's why most countries have this antitrust laws which will prevent this type of merger from happening. For example, General Electric, which is a firm specializes in aircraft leasing and aircraft engines, agreed to buy Honeywell, which is avionics. So GE agreed to buy Honeywell in October 2000. And then the European Commission actually blocked this transaction because this will have this anti-competitive effect in the avionics market. And then merger and acquisition can also have efficiency gains. This is similar to the argument of synergy. Generally, it means that if two firms they merge together, then they can achieve higher efficiency through elimination of duplications. For example, if firm A merges with firm B, then you can imagine that before merger, firm A and B, let's say they both have accounting department. And you can imagine that after the merger has finished, the merged firm will only have one accounting department and one human resource department, right? So by merging firms, we can remove these duplications, and this will improve firms' efficiency. And there will be also tax savings from operating losses. A merged firm could have tax advantage compared with a single product firm. The reason is because it's sort of like the diversification argument. It's because if you are a merged firm, then the loss in one division can be used to offset profit in another division. So loss and profits in different divisions, they can offset with each other. You can see that this kind of argument is quite nuanced because you have to consider this in the context of tax loss carry forward and tax loss carry back, because we know that even if you're a single product firm, if you have a loss, then you can carry forward or carry back, right? So this will also smooth your tax exposure. Okay, let's see this example here. So we consider two firms, incorporation and young corporation. So both firms they will either make $50 million or they would lose $20 million every year with equal probability. The only difference here is the firm's profits are perfectly negatively correlated. That is, if the young corporation earns $50 million, then the incorporation loses $20 million and vice versa. Assume the corporate tax rate is 34%. Now we ask, first, what are the total expected after-tax profits of both firms when they're two separated firms? And the second question is, what are the expected after-tax profits if the two firms are combined into one firm called Yin-Yang Corporation? And we assume it's not possible to carry back or carry forward losses. Well, you can see that this is not quite realistic, but still we can demonstrate the benefit from merger and acquisition. So let's look at the first question. What are the total expected after-tax profits of both firms when they are two separate firms? this is some simple calculation because you can see that we have two cases, right? Either $50 million or minus $20 million, and we have equal probability. And what you can see here is if the firm's profit is $50 million, then it has to pay this corporate tax, right? So times 1 minus 34%. However, if there is if the firm has a loss of $20 million, then there will be no corporate taxes, right? So it's directly, so now we just get 0.5 times minus 20. This will give us $6.5 million. Okay, second, we ask, what are the expected after-tax profits if the two firms are combined into one firm? Well, we know that the profits of these two firms are perfectly correlated. It means that in 1 year, if the young corporation earns $50 million, then the other firm loses $20 million. So the combined firm's profit should be 50 minus 20, right? And you can see that if the young firm loses $20 million, then in firm will earn $50 million, right? So in each year, we'll have the same amount. It's always $30 million. And then times then the tax rate is 34%. So the after-tax profit would be $19.8 million. Again, this is a fictional example. What you can see here is because combining these firms, the operating loss will be used to offset the gain. So we will have this constant number, and then we will have a much larger after-tax profit compared with $6.5 million of expected profit when these firms are not merged. But you can see that, as I said, conceptually this is interesting, but realistically it's not very useful because we know that there is carry forward and loss carry back. Okay, another benefit is diversification. So the argument is exactly the same as the argument we made in Corporate Finance 2. Remember that we discussed diversification. Basically, we're saying that if you put several stocks in a portfolio, then you will have the diversification benefit because basically stocks have idiosyncratic risks. So by combining them into a portfolio, the negative idiosyncratic risk will be used to offset the positive idiosyncratic risk. So basically, different firms' risks will offset each other. So you will get a smoother return from your portfolio. And this is also true when used in the merger and acquisition context. It basically means that if we merge different firms together, we create a large firm. So it's like a portfolio of smaller firms. And these smaller firms' idiosyncratic risks will offset with each other. So the total risk of this large merged firm will be smaller. So the result is the merged firm will be less risky. But you can see that this argument is not that great. The reason is the same diversification can be achieved by investors themselves. right? Because by merger and acquisition, you're combining smaller firms into a large firm. So you achieve diversification. But if you don't do this, investors can basically hold these smaller firms' shares. And then still, investors will get this diversification benefit through holding several firms in their portfolio, right? So basically, the diversification benefit from the merger and
Sorry, I
and
couldn't hear what you said.
oops, sorry, my Apple Watch goes crazy. So basically, you can see that the diversification argument for merger and acquisition is not that convincing. Okay, so if the diversification benefit holds true, you can see that this will have the benefit of increasing the firm's debt capacity and reducing the firm's borrowing cost. The reason is because if the merged firm is more diversified and less risky, then it has a lower probability of bankruptcy. So this basically means the firm's default risk will be lower. That is, the firm's debt cost of capital will be lower. And this means the firm can borrow more debt, increase its leverage, and this will generate larger interest tax shield. So the firm can enjoy larger tax savings from using debt. And then there's also this liquidity benefit. So generally, shareholders of private firms, they're under diversified. That is, you can imagine if this is a so if the target firm is a private firm, then its shareholders, they generally will tie a lot of capital in this private firm. So you can see that if the target firm gets acquired, then these shareholders of the target firm can actually cash out, right? Basically, this means merger and acquisition will increase the liquidity, and this will benefit target shareholders